All right, we are live on all the platforms. Started the music late, so it is what it is. Facebook, LinkedIn, YouTube, and Twitter. Hopefully one day they'll add Instagram on here. I can get down with Graham. Quick video today. Maybe 10, 15 minutes. Gonna run through some stuff. Give you a feeling, my pulse on the market. How does it look? We'll look at data as well. A few things. We're not going to dive too deeply. Today is a big day because of the CPI inflation reports. There's results right there. You can see this is previous over here. Oops. Previous over here. This was expectations right here. And then this was actual right here. So that's basically what we're looking at. And you know, pretty much in line with expectations. The year over year was a little bit better than expected, but pretty much right in line with expectations and similar, just slightly better than the previous report of its nature. So the same year over year, last time was 5%. Now it's 4.9. The core year over year was 5.6. Now it's 5.5. So a little bit better in line with expectations. I think things could have been really bad if this had come in worse. I don't know if things would have been so great if this had been much lower. I don't know. It's interesting what's going on. But that's what happened. So that's the big news today. I was really expecting this to be much better than the expectations. I was expecting something really good on this. I'm also going to include in the YouTube description, which is where we host the main video for this, this link right here, which shows you the breakdown. It's still eggs. Eggs is still crushing as the number one inflationary item. Motor vehicle repair, that's always been crazy, but look at that. Look at that. Motor vehicle insurance, frozen vegetables. These are the things that are at the top of the food chain here. You can also see the things that are down, which is mostly energy, which is really, really interesting. Fresh citrus down, used cars and trucks. So if you want to see the breakdown of it, I'm going to provide that link for you. Let's take a quick look here on the mortgage side. And this is bond activity. Look at it. Look at the size of that thing. Look at that green candle. My goodness. Holy smokes. Exactly what we're hoping for. Now, we opened a lot lower than I would like to see. We opened below the range from yesterday. We've got a nice bullish engulfing candle here, which engulfed the whole week, including the last couple of days. This is a Wednesday. So the last couple of days engulfed back up to here and to where we've met resistance last week. Okay, so last week we had this kind of ding, 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 the Z move, right here. Now we have the Z. And that was a Wednesday when we had our best looking candle last week. So this week, kind of same. What we would like to see is a continuation tomorrow. That's going to be the big difference maker. You can see over here, you can kind of see interest rates didn't change a whole lot today. So what's interesting about this is that the banks didn't really buy this move today. Rates didn't change a whole lot from yesterday. I hedge locked one yesterday in the evening, in fact, which is not usually the best time to hedge lock. And it was it was better than anything that we could get today. Couldn't find a better one today. So pretty interesting. Bank's not really buying it. But if we have continuation tomorrow, if we break this range or break this one any point in the next couple of days, then you'll see, I think, banks get a lot more aggressive. But as it stands, we're still in the same sort of macro range here, sideways action. Nobody's really buying this move. So we didn't see the big drop in rates today that we were hoping for. We got the candle we wanted. We got the bond buying we wanted. But ultimately, capital markets at these wholesale banks, and we're going to pull rates up here in a second. So that's one thing that we will do to finish this off. I'll pull up live rates. We'll do FHA, VA, conventional. I do have a call to make, so I got to keep some sort of eye on the clock here. But that's the big news. So that's the big thing. That's what happened today with rates. We'll look at rates in a second. There's a couple articles I want you to check out. A couple pieces of data here that I think are really worth paying attention to. And this one is a big deal for a couple of reasons. This is the Mortgage Credit Availability Index. Now, mortgage credit availability, what does that mean? That just means that the availability of credit, of loans for people to buy homes. That's essentially what that's looking at. And what's interesting about this is that it's declined significantly since COVID and hasn't recovered at all. In other words, tightening by the banks and tightening in the form of guidelines, making it more difficult for people to borrow, has been going on since COVID, and it's continued. It's just gotten worse and worse and worse. What's really interesting about this, when you look at this chart, because that's something that harms buyers, and I want to pay close attention right now to all of the things that are making stuff difficult for buyers. Buyers have a hard time right now, and I see this firsthand as a mortgage guy. I see this right now. Our pipeline is really small. We have like 5 loans we're working on. It's the lowest I think it's been in years. Buyers have a hard time. That doesn't mean the market's bad. Okay, for the market to be bad, that would mean that, prices were crashing, the market was ugly, nobody wanted to own real estate. Opposite. Everyone wants to own real estate. It's just pushing a lot of people out from an affordability standpoint. It's pushing a lot of people out from a fear standpoint, from a credit availability standpoint. I mean, rates being higher than, they're double what they were a year ago. There are a lot of reasons why we're in this situation. And just think about that. All the things that buyers have had to try to overcome, all of the things that are working against buyers, and prices just won't really go down. They're just not going down. So think about that. Is that a bad sign or a good sign? That's really the question to ask here. It's like if you own Bitcoin, you bought some Bitcoin, let's say, and the next day the US government said we're outlawing Bitcoin, but the price of Bitcoin didn't go down. What would you think about that? Would that make you think that it's more resilient? Or would that make you think that, oh, it's got to crash now? Because when bad news comes, when bad things pile in and things don't really get much worse, that's actually a good sign. On top of that, this mortgage credit availability index, I want you to pay attention to this level that we're at here, 99.6. Look at this. Draw this back over here. Remember, we haven't seen this since 2013. In fact, I think I had it marked somewhere. Anyway, 2013 was the last time we were at this low of a level for mortgage credit availability. And look at the previous times we were at that level. This is all in the bottoming process post the Great Recession, the great real estate crash of 2008. The bottoming process. Remember, we didn't hit the bottom until late 10, early 11. And here's early 11 is where this chart starts. And look at where this was. It was right in the same area. It was kind of cresting right there. Same spot, right at 100 or so. Okay. So that was the last time. And we just took off from there. Price-wise. So in other words, we don't have the left side of this, but we can see that when the last time we were here, we were at a market bottom. The last time mortgage credit availability was this tight, we were at the bottom of the real estate market. Okay. And a generational, just unbelievable bottom. I still think about some of the poor people who fire sold their homes when COVID first began. There was a few people in there who just got steals because people were like, oh God, just sell it. And they lost so much money because the market just took off from there. I mean, just took off. But hey, it is what it is. It is what it is. I understand why they fire sold. I get it. But so that was the last time we saw that. Here's another one. This one's good to look at as well. And I want to talk about one of the things that had me. Actually, let's do this first. So, and I swear to you, when I looked at this exact same screen, I have not changed the filter. I have not done anything other than refresh this. 3 or 4 hours ago, when I first pulled this up, there was like 3 or 4 hot homes on here total. And to me, I use Redfin for data on a lot of different aspects. And when I look at these pages and I see just covered with hot homes, that buyers are out in force. Whenever you see that go away, that usually means things are about to soften up. This morning, 3 or 4 of these homes were hot. I swear to you, unless something changed on Redfin side, maybe it was a glitch. I don't know. 3 or 4 hot homes, and I went, oh, maybe that's why I only have a few loans I'm working on right now. But buyers have a lot of things working against them right now. And it's hard for them to realize that it's not going to get much better. It's not going to get really any better for them. I mean, what would be better for buyers would be lower prices, right? Say, well, no, lower rates would be better for buyers. No, lower rates is going to mean higher prices and more competition. That's not good for buyers. It's not good for buyers. You don't want higher prices and more competition if you're a buyer. But I want a lower rate. But a rate is a psychological thing. Lower rates mean higher prices. It's just like when Melrose comes off of a neighborhood, the prices immediately go up as a result. It's not. It's a zero-sum game. It is. At the end of the day, there's a certain amount people are willing to pay per month. Per month is what it boils down to. So anyway, we've been talking about, buying now, even with higher rates, locking in a better price, because your purchase price, that's something that's you're stuck with that. Your interest rate, you're not stuck with that. Your purchase price, you are stuck with that. So that's what we've been talking about for a while, and that's why. Now I come back here and I just look at this, and there's a lot more hot homes on here than there was this morning. A lot more, way more. Less than a week ago, when I last looked at this, I look at this once a week. Last I looked at this a week ago, it was covered with hot homes. The whole thing was hot. It was crazy. But it's really interesting. You look like, okay, here's Scripps Ranch. I don't have a single hot home in Scripps Ranch. Huh? So that's why I posed the question, hey, is the market finally slowing down? No. No, it's not. It's very difficult for buyers right now. I've got buyers putting 50% down, can't get in escrow. I mean, just wild stuff. People are being crazy out there. There's a few buyers, and a handful of buyers in some of these neighborhoods who are doing crazy stuff again. All cash, 100,000 over list, no contingencies. I got buyers who are putting 50% down. They're running into that over and over and over. Been writing offers for months. It's not a isolated incident. So I think it's always interesting. Now I'm looking at homes under 2 million on this, houses, so detached, 3-bed, 2-bath. Those are my filters. So I do want to see up in the higher price points, but you can see there's still hot homes at these higher price points too. It's not just, it's not just the $600,000 houses, which there aren't anymore. Those don't exist now, but it's also a lot of these hot homes are $1 million or close to it. Look at that. Here's one for $949. Hot home, 92127. That explains it. That would be a hot home in the 92127 for under $1 million. Here's one for $125. That one is also in the 92127. Hot home. So you see I just look at this just for pure sentiment, because when Redfin declares a home hot, they're basically saying that they're seeing that a lot of people are looking at it. A lot more people are looking at it than other homes that are similar, so are similarly priced in the same area, and they believe that this one is going to sell and sell quick because there's so many people looking at it, and people are going back and looking at it again and again. So that's a sentiment check. Honestly, I thought I was going to look at this and see just a few hot homes and go, hey, what's going on? That was what I had planned to say, but we have to look at the data. Look at the data. I'm not, people think I'm just blindly bullish on real estate. I'm not, but you're a fool to be bearish on it unless you have the perfect timing. And man, you have got to be really savvy. You've got to be really savvy to be bearish and be right. You got to say when it's going down and when it's done going down. That's hard to do because real estate goes up and to the right. You can pull up any graph you want. That's what it looks like. So, and I was just looking in this area because this encompasses a lot of different stuff. You can see, La Jolla in here, Pacific Beach here, El Cajon is in here, Poway's in here, Scripps Ranch is in here, Rancho Santa Fe, Encinitas. You can get Carlsbad, a little bit of San Marcos, Escondido's in here. So you got, this is this one screen right here, because if you zoom out too far, it doesn't show you this. It like consolidates it. It'll only show you the Redfin listing. So you have to zoom in to a certain point before it'll actually show you the houses. So I try to pick the place, and I want to look in the same area each time that encompasses a good portion of San Diego County to try to get a feel for what's going on. This is a great way in a couple seconds just to get a snapshot of what the market looks like. Okay, last graph. And then we're going to look at rates, and then I got to roll. Housing sentiment is rebounding higher. Notice here, remember when I said sentiment is low? Sentiment is super, super low, but price won't go down. It just won't go down in most places, particularly in San Diego County, but in most places, price is being very, very resilient. Sellers are not giving their properties away. And it looks like we may have had a bottom in sentiment. That bottom would have been at the very end of last year when rates were at their peak. Sentiment continuing to rise. As rates are moving in the right direction, still a little bit higher. We're going to pull some up here in a second, but what we're going to see when we pull them up is, high fives and low sixes. So still sort of higher rates than what people would like to see. I mean, if rates were in the fours or something like that, the market would go crazy. It would go crazy because you'd actually get some sellers who would go, okay, I'll give up my 3 for a 4% and we'll move on. Sellers are not willing to give up the 3 or 2% they have right now for a 6%. They just across the board don't want to do it. And that's why we have such an inventory issue. But sentiment appears to have bottomed. And as you can see, have reached a point lower than where we were post-crash, pre-bottom back in 11. So when we bottomed essentially here in 11, let's just call this the bottom because I believe it was right around here. The actual price bottom, I think, was a little bit over here. But, September of 11, we got down into the 50s. We got down further than that this time. Can you now think about that? This is a divergence, which I'm not going to try to explain, but it basically means, prices were much, much lower in 2011 than they are today. But we reached a sentiment point today in the last 6 months that was lower than that. That is a bullish divergence. It is a macro buy sign. Get out your guns and pull the trigger. Whatever it is, whether it's a stock, a commodity, a house, whatever, you get a macro divergence like that, you just pull the freaking trigger. I don't care how hard it is or how ugly it looks. You just go. You get some of that. So this right here, to me, is the biggest bull sign of them all by far. So, all right, let's do this. We're going to pull up rates quick. Let's see here. Do I have FHA going already? Let's do this. I want to get high balance and I want to get conforming balance. So this will be conforming balance. FHA, no points. And then we'll do high balance next. So 5.75. Orion, nice. Orion and Mutual of Omaha, which is located in San Diego. It's pretty cool. 5.75 right there. And your 5.65, only $813 for a 5.625. I would probably take that if I was you. All right, let's do a high balance here. Let's say 950. If I can do some quick mental math. Oh, a little too much there, maybe. All right, let's check this out. High balance FHA. So we know that conforming balance FHA was 5.75. Oh, shoot. I'm not showing you guys that, am I? It was 5.75. And high balance, also 5.75. Let's go VA now. And we'll just kind of, let's stick with this. Let's start high balance for VA. I think this is going to be higher than FHA right here. No. Yeah. Oh, yeah. We got two different 5.75s. Mutual of Omaha and AFN. I would definitely go Mutual of Omaha in that, with those choices, given those choices, even though you can see higher comp on AFR. All right. Now let's go to conforming balance for VA. Also 5.75. Okay. Making it real easy on me, guys. 5.75 across the board, FHA, VA, high balance, conforming balance. That's the rate today. That's where we're at. That's what it is. All right, let's get to the more finicky conventional. Let's look at conventional rates now. So we're going to do conforming balance rates. Now I'm just doing minimum down payment. For FHA, it really doesn't matter much on rate. For conventional, it can. If you put 25% down or more, your rates can be a lot lower. But we're just going to do the minimum down payment here. So conforming balance, no points, no lender fees. What we got for conventional? I guess it's going to be around 6.5, maybe 6.375. If you want to know what the life of a loan officer is, it's staring at screens like this shit all day. All day. I know like AI and computers are going to one day be faster than us, but I spend so much of my day waiting on that bullshit. I cannot explain it to you. Drives me nuts. 6.375. All right. 6.375. And you got some fast banks in there too at 6.375. So that's good to know. Conforming balance right there, 6.375. Now let's check out high balance. We'll do a milli. And let's see how the high balance conventional looks. 6.75 JMAC coming in at the top spot. I had a wholesale, pretty far away there. JMAC 6.75. This is fixed. I'm not going to look at arms or anything like that, but that just gives you an idea, of kind of where that's at and, where we're at versus this stuff over here. Pretty much a quarter point lower. On the FHA and VA, we're like 0.3% lower. On the conventional, we're basically right there. That's the average of 6.57. So we're 6.375 to 6.75. So pretty much right on with that one. Conventional is kind of the same. You can still get ripped off on a conventional loan. Don't get me wrong, but for the banks that are trying to be competitive and on the wholesale side, like where I am, you're going to pretty much see that it's just kind of everybody's got the same. Okay, so let's play this thing off. That's it for today. Hope it's helpful. You know what to do. Someone wants to get a good deal on a home loan, shoot me an email, call, text. I'll be here. I'll hook you up like a tow truck. I only got 5 loans in the pipeline, bro. I got time. I can help you. I'll be here. Give me a shout if you need. Have a great one, team.